Today, I have the pleasure of talking to you on a subject which is very fascinating, a subject in which I got interested a few years back. I am approaching the subject with a mixed feeling of excitement and trepidation. Excitement because I am very, very interested in the subject, trepidation because I am still a novice in the subject. If we look at finance in the last 60, 70 years, we find there are three strands of finance: quantitative finance, behavioral finance, neuro finance. Quantitative finance has dominated the field of finance from mid-1950s, and it reigns supreme even today. Quantitative finance has been pioneered by giants like Harry Markowitz, Fisher Black, Modigliani, Merton Miller, William Sharp, Eugene Fama, Myron Scholes, and others. Incidentally, all of them got Nobel Prize in Economics for their outstanding contribution to finance and economics. Peter Bernstein, an eminent financial historian, wrote a very fascinating book called Capital Ideas. In this book, he talks about how these ideas, which emanated in the world of academia, swept the world of practice. While quantitative finance has been the dominant paradigm in finance and investment for the last few decades, from mid-1970s, cognitive psychologists and others have challenged some of the assumptions of quantitative finance. If you look at all the important models of quantitative finance, such as modern portfolio theory, capital asset pricing model, efficient market hypothesis, option pricing model, they are based on a number of assumptions. The three most important assumptions are: people form judgments and beliefs accurately, people act rationally and in a consistent manner over a period of time, markets are efficient. If you look at the real world, you find these assumptions are often not valid. Some new movement called behavioral finance. It's very interesting. The movement was triggered by a cognitive psychologist, Daniel Kahneman, who became a Nobel laureate in economics in 2002. And some of the pioneers in the field have been Robert Shiller and Richard Thaler. Incidentally, all of them became Nobel laureates in economics, indicating the growing importance of behavioral factors in finance. In the last 20, 25 years, with the improvement in techniques of neuroscientific research, neuroscientists have started looking at neural underpinnings of financial behavior. It's a nascent discipline, but a discipline which is growing exponentially because of the massive research that is being done. Today, I wish to give you a brief idea of what is being done in this area, and toward the end, we can have some questions from your side. Neuroscience has grown by leaps and bounds. I'll come to some of those things within a few minutes. For the timing, let us understand that neurofinance is an interdisciplinary study that applies neuroscience to investment and financial decision making. It discusses why and how people make non-optimal financial decisions. It suggests techniques for correcting neural biases. My talk is organized into 5 parts: investor irrationality, brain basics, key findings of neurofinance, the future of finance, and some guidelines. All of us know how irrational investors can be from time to time. I will take you through a very interesting personal journey of mine. I've been an observer, student, and participant in the market from the early 70s. And over a period of time, I have a number of interesting anecdotes to narrate. For the time being, I limit myself to what I have seen from 1991 onwards, when India ushered into a new era. In 1992, I was attending the board meeting of an asset management company of UTI in Mumbai. When we were having the meeting, the fund manager of UTI came to the boardroom and said, Saab, laddu khaiye. I said, what happened? He said, for the first time in the history of UTI, a single scheme called Master Gain Scheme has gathered 4,000 crore rupees. I was a little surprised as to what happened, but it was not totally surprising. Earlier, UTI had great difficulty in gathering 100, 200, 300 crores for various schemes, but now in 1992, a single scheme has gathered 4,000 crore rupees. And you must know the background against which it happened. 89, 90, 91, 92 were excellent years for investors in the stock market. And in 1992, thanks to the Arshad Mehta effect, the market was extremely buoyant. The P multiple of the market had already crossed 40, 45. So I told this fund manager, this is not a matter of celebration, it's a matter of concern. If you gather 4,000 crore rupees in the market is 40, 45, you will never be able to provide a satisfactory return at least for a decade. And that is precisely what happened. In 2003, the market P was barely 11. The TMT bubble led to a collapse in the market, and 2002, 2003 were very bad years, at least till the middle of 2003, and P was barely 11. And it appears very unusual that the entire MF industry gathered just 100 crore rupees. From 2003 onwards, the market started booming, and when it was at its peak in 2008 and the P was over 25, mutual funds gathered more than 50,000 crore rupees. What do we find when you look at these experiences? Investors go by just one number, the return earned by a particular asset class in the last 3 to 5 years. In 92, they looked at returns in 89, 90, 91, 92. In 2003, they looked at returns in 2000, 2001, 2002, and in 2008, they looked at returns from 2003 onwards. Investors chase return, they simply extrapolate what they have seen in the past. A very interesting study has been done by Sankar Dev, Indian School of Business, in which he examined daily trading data of 1 million investors from January 2005 to June 2006. They looked at 1.4 billion trades worth 37 lakh crores, and they found that retail investors consistently chase zero return when they decide themselves. And January 2005 to June 2006 was an extremely buoyant period. Even during that buoyant period, they didn't earn any positive return. And the Benjamin Graham quote, known to all of you, is this: the investor's chief problem, even his first enemy, is likely to be himself. There's a very fascinating article written by an eminent behavioral economist, Werner Debond, a portrait of an individual investor, in which he looks at the behavioral characteristics of investors, particularly individual investors, perception of price movement, investors spot trends and see patterns where none exist, investors naively extrapolate, investors perceive likely variation in equity returns to be too narrow, investors are overconfident in their prediction. Perception of value, they have an inadequate understanding of valuation techniques. Their value estimates are based on popular models or stories in news media. They can't distinguish good companies from bad companies. Managing risk and return, they are often under-diversified. The idea of risk being defined at a portfolio level is alien to them. They overinvest in riskless assets. They believe that after committing their funds, they can manage risk through knowledge and trading skill. Trading practices, while seasoned traders have the discipline to exercise stop loss orders, most individual traders lack such discipline. Their trading impulse and their trading sentiment trace the market. You find that happening everywhere, not just in Europe. It is in US, it is India, it is everywhere. Here is a very interesting piece of information all of you must be familiar with the legendary fund manager Peter Lynch, who managed the Magellan Fund for 13, 14 years and had the best track record of any fund manager. During that period, he delivered a return of 29.5% versus 15.5% for S&P 500. But surprisingly, the average Magellan investor realized barely a return of 5%. Many actually lost money. A very similar evidence comes regularly from Dalbar, a Canadian agency which analyzes returns that individuals earn versus returns that mutual fund investments provide. In order to understand the difference, let us look at a very simple example. There are two measures of rate of return, geometric average or geometric mean, which is also called the investment return, and internal rate of return or dollar weighted rate of return or rupee weighted return is called the investor return. If I look at a very simple example like this, we can easily understand the difference between the two. Let us say a fund has started operations at this point of time where it gathers 100 crore rupees. The fund does extremely well in the first year and provides a return of 100%. Investors get excited when the fund grows in value from 100 to 200 crore rupees, and at that point of time, a lot of money flows into the fund. The fund corpus grows from 200 crore to 500 crore. The second year turns out to be a disastrous year, and the portfolio value collapses from 500 crore to 250 crore. The geometric mean or geometric average return over the 2-year period works out to 0%. It is 1 plus R1 plus 1 plus R2 raised to the power 1 by 2, which is 2 plus 2 into 0.05 raised to the power half minus 1. This is the investment rate of return. The fund manager may say that over a period of 2 years, I have generated a return which is 0%. Look at the experience of the investors. If you look at the collective experience of investors, they have poured in 100 crore rupees at this point of time, and then they poured in another 300 crore rupees at the end of year 1, and they are left at the end of year 2 with only 250 crore rupees. So if I set up a simple IRR equation, I find that R is equal to minus 32%. This is an extreme example to demonstrate how investor return can diverge significantly from investment return because investors chase returns. Don't be under the impression that these mistakes are committed only by dumb investors. I have a very interesting example of Isaac Newton, who lost his fortune in the South Sea Corporation investment. Some of you may be familiar. Isaac Newton was the brightest mind of his time at that time. And he's also the master of mint, which is the modern day equivalent of Chancellor of Exchequer. So he was not financially naive or unsophisticated. He was financially very sophisticated. South Sea Corporation received a monopoly right from the Royal Crown to trade with Latin American companies. When Newton learnt about it, he invested in the shares of South Sea Corporation in February 1720, buying them at £100 a share. And by May, the price had appreciated to 300, and he sold at 300 what he bought at 100 and had a 200% return. But the price kept on rising. It went to 700. He could no longer contain his envy or regret. And he saw a lot of his friends earning stellar returns. Out of regret, he entered the market. This time he put almost his entire wealth into the market, buying it at 700. The market rose for a while and then dropped very sharply. in few months, and he had to liquidate his position 100. This is what happens, and this is what Newton observed. I can calculate the movement of heavenly bodies, but not understand the movement of stock prices. And Buffett made a very interesting comment. If Sir Isaac Newton had not been traumatized by the losses, he would discover the fourth law of motion. Returns diminish as motion increases. We have another example of Irving Fisher, the most celebrated American economist of the first half of 20th century, an outstanding economist at Yale. In 1929, he said the economy had reached a permanently high plateau and invested all his money along with a lot of borrowed money in the stock market, and the market plunged and he became bankrupt. We have a more recent example, long-term capital management, a hedge fund promoted by the best minds in the finance world. We had two Nobel laureates and Mary Bellwether. All of them were regarded as superstars. They did well for a while, but they took very huge leverage positions, and when the market collapsed, the firm had to be dissolved. Richard Peterson, a neurobiologist, says after several years of success, greed, hubris, and arrogance infected the partners' decision making and impaired their communication. In investment management, mathematical genius may perform well in the short run, but is no substitute for emotional intelligence. Amos Tversky, an outstanding cognitive psychologist and a long-time collaborator of Daniel Kahneman, was in the psychology department of Stanford University, and he used to say, my colleagues in the economics department study artificial intelligence because they endow economic agents with extraordinary intelligence, whereas we in psychology department study natural stupidity. We make mistakes all the time. We are homo mistakers, not homo sapiens. And Daniel Ariely, an eminent behavioral economist, says we are predictably irrational. Why are we so irrational? Because of a mismatch between our brain and the environment in which we live. Our brains are well designed to the environment we faced 150,000 years ago in the African savannas. Remember, we evolved over millions and millions of years, and then we became hunter-gatherers in the African savanna 150,000 to 200,000 years ago. The brain evolves glacially and very slowly over a period of time. Our brains have not changed much since then. The brains which were well suited for the African savanna are poorly suited for the industrial age, which began nearly 300 years ago, and even more ill suited for the information age in which we currently live. According to a very popular model of human brain, the triune model, the brain has three parts: brain stem, the reptilian brain; limbic system, mammalian brain or emotional brain; neocortex or hominidic brain or rational brain. Reptilian stem is the oldest part of the brain. Then came the limbic system, and limbic system evolved over millions and millions of years. It went through tens of thousands of iterations, and it is in version 5. Our emotional brain is highly developed. It is version 5. The rational brain is the most recent addition to the human brain, and it is in version 1. And all our problems are traceable to the fact that our emotional brain is in version 5, whereas our rational brain is in version 1. We have a bad design of the brain in relation to the environment in which we live, so we make bad decisions which are bad outcomes. This is what Daniel Kahneman wrote in his fascinating book, Thinking Fast and Slow, where he challenged the assumption of rationality assumed by the quantitative finance model. He was awarded Nobel Prize for integrating insights from psychological research into economic science, especially considering human judgment and decision making under uncertainty. This is a very fascinating book. I'm sure most of you have read it, but if you're not read it, please go buy a copy and read it. And if you already read it, reread it. I have read it several times, and every time I read it, I find it so novel and interesting. Another fascinating book is by Richard Thaler called Misbehaving. He got Nobel Prize in Economics in 2017. So Taylor, Schiller, and others have been arguing that we make all kinds of mistakes because of this mismatch. Essentially, there are two systems at work in the human brain, System 1 and System 2. System 1 is fast, effortless, automatic, instinctive. You can call it as the emotional brain, or System 2 is slow, effortful, deliberate, rational. Most of the time, our brain operates in the automatic System 1 mode. We are cognitive misers. Brain consumes most of the energy, so we run on autopilot most of the time. In a typical day, we may take 10, 20, 30,000 decisions. I may move a finger, I move a lip, I will raise my hand, I will walk. I do all kinds of things. If you analyze your day, you would have taken thousands and thousands of decisions, and they are taken by System 1, which is fast, effortless, automatic, and instinctive. These are the basic differences between System 1 and System 2. Most of our decisions are taken by System 1, and that is why we are error prone. About 200 biases have been identified by cognitive psychologists and behavioral scientists. To my mind, the most common ones are shown here. If I have to identify the key biases or heuristics which impair our investment performance, they are shown here. There are 7 ones. The acronym is MIRRORS. M stands for myopic loss aversion. To my mind, this is a single most factor impairing investment performance. People are myopic, they are short term, they are myopic in a temporal sense as well as a cross-sectional sense. Temporal myopia means you want results immediately. Cross-sectional myopia means that if I have a portfolio of 15 stocks, I look at each of these stocks individually. I don't look at them collectively. We suffer from myopia. We suffer from loss aversion. Losses are felt much more than gains are felt. High integration, we have a strong herd instinct. We want to follow the crowd. We want to be with the herd. Our recency, our judgments are largely colored by what has happened very recently. Our risk perception, we are very poor at judging risk and probabilities. Overconfidence, we tend to overestimate our abilities. Our results, we judge things by results. We have an outcome bias. S, stories, we're captivated by stories. That is how the human mind has evolved over millions of years. Let us quickly look at brain basics before I go to the heart of my talk, which is a set of findings that we can reflect on the basis of neuroscientific research. The brain is the most complex organ known. It is a product of millions of years of evolution. A typical brain has 100 billion neurons, with each neuron being connected to thousands of other neurons through synaptic connections. So you have trillions of connections. The brain is divided into innumerable parts. You know, when I wanted to prepare this session, I looked at that, and after some time I gave up. I said, this organ is the most complex organ with hundreds of parts, each doing something very specifically, but also participating in the overall activity of the brain. So we call it as globally local and locally global. Even though we have made rapid advances in the last 20 years, our understanding is very limited, and you find a lot of disagreements and controversies in this area. So whatever I am going to say will have to be taken with a pinch of salt, because uh, from whatever reading I have done, I realize that there is controversy surrounding everything, but we'll try and focus on those findings on which there is a measure of understanding. Impressive progress has been made in understanding the neurobiology of decision making thanks to these technologies. You have EEG, PET, fMRI. We are all familiar with these because they're used extensively in medical care. The new tools have done to neuroscience what microscope has done to biology and particle accelerator has done to physics. There are some very interesting books that I found that have illuminated my understanding. These are three. There are several more. Jason Zwick has written a very fascinating book, Your Money and Your Brain. Richard Peterson, a neurobiologist, has written a book, The Insight, the Investor Brain. Michael Gazzaniga, a neuroscientist, Human. These are their covering pages, and you can see the glowing remarks made by Daniel Kahneman, Peter Bernstein, and David Raymond for Jason Zwick's book. Likewise, this is a very fascinating read. And the third book that I recommend is called Human by Michael Gazzaniga. There's another book which I found very interesting, written by David Linden, The Accidental Mind. The myth is that the brain is a paragon of design. Many people say it is the ultimate thing that God has created. The reality, the brain is not optimized, general purpose problem solving machine, but rather a weird agglomeration of ad hoc solutions that have been piled on through millions of years. So we have to explode the myth that the brain is a paragon of design, representing the best God could produce after enormous deliberation. The brain has evolved over a period of time as a weird agglomeration of ad hoc solutions. The anatomy of the brain and the physiology of the brain. As I said, there are three parts, the reptilian brain, limbic system, and the neocortex or the rational brain. This is how one can look at the diagram of the picture. This is a picture that I borrowed from MIT OpenCourseware. The brain stem, the reptilian brain, is responsible for respiration, circulation, temperature regulation, balance, and so on. You don't have to bother about it. It is the most developed part of the brain. We don't have to do anything. We breathe all the time. We have blood circulation, our temperature is regulated, so on and so forth. Our thrust will be on the limbic system, which is the emotional brain, the most highly developed part of the two systems, the limbic system and the neocortex system. And it has some parts like amygdala, thalamus, hippocampus, parahippocampus gyrus, fornix, cingulate gyrus. I'm sure if I have to describe these terms, I'll have to have two medical dictionaries besides me. But for the time being, I am presuming that you will have enough curiosity to look up these terms if you want to understand a little more about them. And today, ample literature is available in various ways. This is the brain, which is also called as the reflexive brain, which is the seat of emotions, instincts, and motivation, greed, fear, lust, envy, anger. These are emotions which are deeply embedded in our brain. Instincts, fight, flee, freeze. All of them are so highly developed, and that is why No computer can ever replicate what our limbic system does, and while a supercomputer can do the job of the cerebral cortex a little better or much better, it is very unlikely that you will have a supercomputer available, at least in the foreseeable future, which can replicate the functioning of the limbic system, which, as I said, is in version 5. The neocortex brain or the hominid brain again has a number of parts. Uh, this is how I would say that the cerebral cortex has two hemispheres, left and right. There is a debate among neuroscientists. Some say the left sphere is concerned with language, writing, logic, mathematics, and has linear reasoning. The right is concerned with spatial awareness, music, creativity, gestalt, imagination, emotional experience, and it has a holistic way of doing things. The cerebral cortex again has a number of parts: prefrontal cortex, orbitofrontal cortex, ACC, medial prefrontal cortex. The functions that are largely associated with these components are listed here. I'll be happy to share the presentation for those of you who want to go through it in a more leisurely fashion. Now you have so many neurochemicals. So far, more than 100 neurochemicals or neurotransmitters have been discovered. These are the ways by which various neurons communicate with each other. It's hard to imagine how complex that machinery is. 100 billion neurons firing scores of neurochemicals simultaneously. It is like having a Diwali nationwide within your brain. And you have so many neurochemicals. The most important ones are dopamine, the reward molecule, serotonin, the confidence molecule, epinephrine, adrenaline, the energy molecule, oxytocin, the bonding molecule, endorphin, the pain-killing molecule, GABA, the anti-anxiety molecule, and endocannabinoids, a bliss molecule. All of us are familiar with some of these terms. Now, let me go to the heart of my talk, which is concerned with key findings on neurofinance. At the outset, let me say that very broadly, neurofinance or neuroscientific research in finance has substantially endorsed what behavioral economists have been saying in the last few decades. Finding one, there are two aspects of human behavior: the reflexive behavior and the reflective behavior. The reflexive system is the intuitive system, the reflective system is the analytical system. The human mind is a cognitive miser. We don't want to invoke the reflective system. We rely by and large on the reflexive or intuitive system. That is how we have evolved. As I already mentioned, system 1 is fast, effortless, automatic, instinctive. System 2 is slow, effortful, deliberate, rational. They found some neural correlates to the two systems. System 1, amygdala, basal ganglia, lateral temporal cortex. System 2, anterior cingulate cortex, prefrontal cortex, median temporal lobe. Humans have two minds with respect to time. You have an emotional grasshopper and the analytical hand. That is why sometimes we want immediate reward. Sometimes we are willing to wait patiently over a period of time. The limbic system is highly sensitive to immediate reward. The prefrontal cortex or the rational brain is more sensitive to higher future reward and is willing to signal behavior which will result in current sacrifice being rewarded in future. If a person has a well-developed prefrontal cortex, he is likely to be more far-sighted. If a person does not have a very well prefrontal cortex, he is likely to seek immediate rewards. Finding 3, there are two kinds of goal-directed behavior. This is a very important finding. Uh, Reward pursuit or loss avoidance. Neuroscientists have found that our goal-directed behavior can be divided into two categories: reward pursuit, loss avoidance. The neural circuits of both these kinds of goal-directed behavior run across the three segments of the brain. And the important finding is when one is activated, the other is deactivated. This has a very interesting implication. When you are pursuing reward, you are not bothered about losses, because when the reward circuit is on, the loss avoidance circuit is off. And that is why we alternate sometimes between greed and fear. When we are pursuing reward, we become very greedy, and when we are concerned about failure, we become very, very loss averse. Uh, I read a very interesting statement made by a very eminent options trader. All of you must be knowing him, Nassim Taleb. And he says we have a great difficulty in doing any kind of probabilistic analysis, because if I look at a very simple example where you have an investment of $1,000 with a payoff of $2,000 on the positive side and a payoff of $500 on the negative side, when I think about $2,000, I think only on the positive side. I don't think about the negative side. When I think about that loss, I don't look at the positive side. So he says we are not designed to deal with things probabilistic, and the neural biology also suggests that either you are looking at the reward or you are looking at the losses, and that is why you find that people behave so differently over time, and that is why you say at times market is now risk on, market is now risk off. This is the reward system where nucleus accompanies dopamine pathway, and you look at positive side of things. And when the reward system is activated, we tend to become very greedy. We want more. Ye dil mange more. And when the loss avoidance system is activated, amygdala, hypothalamus, and others are involved, then we become extremely anxious and fearful. So you have a very interesting neurobiological support for the reward system and the loss avoidance system that we encounter frequently in the world of finance. The neural systems of reason and emotion are linked. Antonio Damasio, an eminent neuroscientist, has written a very interesting book called Descartes' Error. I recommend it to those who want to go deeper into the subject, in which he propounds what is called the somatic marker hypothesis. He narrates a number of stories. Here is one story of a patient whose ventromedial prefrontal damage blocked emotions. For those who are a little confused or perturbed by this complex term, ventromedial prefrontal component is that part of the brain which connects the rational brain with the emotional brain. And if that is damaged, you don't have any connectivity between the emotional brain and the rational brain, and you can't make even simple decisions like choosing between two dates for an appointment. What does it essentially essentially mean? All our decisions have to be fired or fueled by emotions and regulated by reason if we want to take balanced decisions. Uh, Emotions enhance decisions making in two ways. When a decision is important, you require emotions to uh, provide the fuel for going ahead. Emotions improve the quality of decision. Positive emotions promote creativity and sharpen problem solving. So emotions are absolutely essential for human existence and human decision. I would say emotions are the lubricants of reason. Don't say that this person relies only on emotion. Everyone relies on emotion. We require the right balance between emotion and reason to achieve our goals over a period of time. Finding five, most judgments are driven by intuition or gut feeling. And this is a very, very important finding. There's a very fascinating book called Behave, written by Robert Sapolsky, one of the world's leading neurobiologists at Stanford University, in which he makes a very powerful statement. He says, what you do at a conscious level is nothing but you justify your intuitions and visceral reactions. We all pride ourselves in being very rational, conscious individuals. According to him, most of the decisions are taken at the subconscious level. The conscious brain only justifies or rationalizes what the subconscious brain decides. The subconscious brain is the elephant. The conscious brain merely follows the instructions of the elephant. I have a very interesting comment to make. I say human beings are not rational creatures. Human beings are rationalizing creatures. We think that we rationalize a certain decision that may have been taken at a subconscious level very intuitively. At the rational level, we only justify that decision. Like saying that the conscious brain is only an advocate for what the unconscious brain wants. Finding six, there's also a very interesting finding. Anticipation is far more intense than realization. Expectation, both good and bad, uh, are more intense than actual experience. We often find that the journey is far more interesting than the destination. When we are working on a project, we're excited because we are expecting something. But when the project comes to a conclusion, the actual experience is far less exciting than the process of achieving that outcome. Uh, Again, they have found that there is a deep brain area called nucleus accumbens, which is primarily activated when you are anticipating reward, and an area called medial prefrontal cortex in the uh, uh, hominid brain, which is activated when monetary reward is received. Uh, Here is an interesting diagram. This was the assumption made by psychologists and neuroscientists long back. They said the dopamine level rises sharply when you receive your reward. But this is a reality. When we work on a project or assignment, the dopamine level surges. Likewise, when you make an investment, which you want to hold for a while, the dopamine level surges, and when the actual reward comes, it collapses. There is a very interesting saying in North India, जो नहीं है मजा पाने का, वो है पाने के अरमाने का. The pleasure of anticipation is far greater than the pleasure of realization. I also seen that in many situations, if I'm working on an article for several weeks, the process is far more enjoyable. But when the article is finally published, the reward is arrived and the dopamine collapses kind of thing. And I'm sure uh, all of you have experience of that kind. Suppose you're planning a world tour in next March. I'm sure you have a lot of excitement planning a variety of details about that trip, and that planning process is very, very exciting. But the actual trip is likely to be less exciting than the process of anticipation, the process of planning, the process of expectation. In fact, they have found something more to it. They said if the reward is almost guaranteed, then the dopamine surge will not be very high. But if the reward is somewhat uncertain, dopamine surge is higher. So we love taking risk and enjoy the process where there is some uncertainty surrounding risk. Uh, Again, they found that a monetary reward activates the ventral tegmental area, which releases dopamine into the reward system and nucleus accumbens. The same pattern is found in cocaine addicts. In the case of cocaine, we call it addiction. In the case of money, we call it capitalism. Human beings are pattern seekers. Human beings hate randomness. There's a module in the left sphere of the brain called the interpreter. Uh, we don't like disorder. We impose order where none exists. We impose a pattern where none exists because we hate randomness. We have a module in our brain which imposes an order. Humans suffer from the illusion of control. There's an uncanny feeling that we exert control over random choice with our action. I have often seen it in several situations. A few months ago, I was playing Monopoly with my grandchildren, and one of them was rolling the dice very, very hard. I said, "Why are you doing that?" He said, "I want a higher number like 11 or even 12. I said, "How hard you try, it is a random outcome, but we believe that we can control through our action a random choice. And this is precisely what happens in the stock market. If I buy a stock, I think I can control the outcome. There's a caudate area deep in the reflexive brain which serves as what neuroscientists call the coincidence detector. Finding 9, risk tolerance is variable. In reality, our perception of risk is in constant flux, depending on our memories, past experiences, whether you're alone or part of a group, how familiar and controllable the situation is, how it is described, how it is framed, what mood you happen to be in. There's an interesting book by John Coates called Biology of Risk, in which he says humans are designed with shifting risk preferences. They are an integral part of response to stress or challenge. Finding 10. This is a very interesting finding. Risk and uncertainty are experienced in different ways. There was a famous American economist, Frank Knight, who wrote a pioneering book called Risk, Uncertainty, and Profit in the early part of the 19th century, in which he, for the first time, differentiated between risk and uncertainty. Now it is part of general understanding. Risk refers to a situation where possible outcomes are known and probabilities can be assigned to these possible outcomes. Uncertainty refers to a situation where possible outcomes are not known, and so you cannot define any probabilities or assign any probabilities. Today we are living in a world of uncertainty. In fact, John Kay and others argue that we live in a world of radical uncertainty. Now, how do we deal with risk and uncertainty at a neurobiological level? When we face risk, the most active region of the brain is parietal lobes. This is a region primarily concerned with cognition. When we face uncertainty, the most active regions of the brain are orbitofrontal cortex and amygdala. Now, these are regions which are primarily centered on emotion. And that is why we
have very strong emotional reaction to uncertainty, but we deal with risk more sensibly because risk is processed in the rational brain primarily. Uncertainty is processed in the emotional brain, which has an acute aversion for uncertainty. Finding a love in human beings are hypersocial creatures. We have herd instinct. We learn from each other easily and naturally. And social attachment occurs when uh, the brain chemical oxytocin is released. They found that uh, uh, there are two components of brain which are activated: dorsal anterior cingulate cortex and insula. When you are socially excluded, both the regions also process physical pain and show greater activity when a person is ostracized. Finding 12. Our brains are designed to seek out novelty and make finding it rewarding. We often conflate novelty with reward. This is a very interesting finding, and I'm sure all of you have experience of this kind. Uh, the other day, someone came to me and said, I want to show you my portfolio. I said, okay, I'll have a quick look at it. And he had about 35 different mutual fund schemes in which he invested. I said, why did you invest in so many schemes? Three, two, four, five would have done sufficiently well. No, sir, every time a new fund offering came, I thought it was likely to be more rewarding, so I picked up funds as and when they were offered. That's the reason why asset management companies provide new fund offerings all the time, knowing full well that these funds are likely to attract people because people conflate novelty with reward. Uh, I also had a very interesting experience. Someone said, can you have a look at my portfolio? He was a very close friend of mine, and he said, I want to show you my father's portfolio first. I said, okay, I'll have a quick look at it. Here are 185 different stocks, and I'm sure he must have subscribed to every possible IPO during a long investment career. I said, is your father an investor or a collector? 185 stocks in a single portfolio. People get attracted to novelty, and I get a lot of calls from my friends and relatives. What do you think about this stock? What do you think about that stock? Which essentially means that people uh, don't look at their existing portfolio very seriously. They are attracted toward novelty because in our brain, novelty and reward are conflated. People are reference dependent decision makers. The brain makes comparisons of relative value rather than absolutes. This is a very important neuroscientific finding corroborating prospect theory. Uh, all of you are, I'm sure, familiar with Kahneman's prospect theory, which fetched him Nobel Prize in economics. The key tenets of prospect theory are reference dependent. We value gains and losses relative to a reference point. Diminishing sensitivity, we have diminishing sensitivity to gains and diminishing sensitivity to losses. We are loss averse. Losses hurt us a lot compared to the benefit that we receive from gains. We experience changes in risk attitude. In the gain region, we are risk averse. In the loss region, we are risk loving. This beautiful diagram, which reflects prospect theory, conveys so much about human behavior, and neuroscientific findings are supported it by and large. Our brains economize on scarce metabolic resources. As I said, we are cognitive misers. We repeatedly use the same brain circuits, and that is why we tend to be biased most of the time. Finding 15, exposure leads to attachment. Human home circuit is what neuroscientists call it. It is human oxytocin mediated empathy is extraordinarily powerful. That is why we invest in the stocks of companies that we work for. We have a strong endowment effect. Familiarity does not breed discontent or dislike. Familiarity breeds liking. We have a story bias. Humans have evolved to use narratives to explain the world. Uh, uh, William James, founder of psychology, said people believe in narratives because narratives are useful and believing in them provides psychological comfort. As Kahneman said, no one ever made a decision because of a number. They need a story. Here is a very fascinating summary of one of the chapters from the book Human. Based on his experiments, Michael Gazzaniga said that the right hemisphere of the brain just records facts. It is responsible for the who, what, when, and where of reality. It's a very objective portrayal of facts. The left hemisphere of the brain interprets the facts and comes with a narrative for which it has a natural pancha. And we are inclined to to create a narrative story very easily because we have a left hemisphere which has an interpreter, irrespective of how inadequate, vague, and uncertain the information is. We have a pancha for creating a narrative, creating a story. I found this very illuminating. Every time I met someone, he had a very compelling story to narrate, and everyone was so convinced about his or her story. So this is our pancha for creating a narrative, and out of limited facts, uncertain information, and vague situations, irrespective of how vague and uncertain and inadequate our data is, we are capable of creating a story. That is how the human mind is evolved. The brain is a machine for jumping to conclusions. And Kahneman calls it as the what you see is all there is. That is a YCIT principle, a rather awkward acronym. When information is scarce, which is common occurrence, system one operates as a machine for jumping to conclusions. So you'll find that everyone has a story to narrate, whether he is a stockbroker or a driver or the president of a company or the governor of Reserve Bank of India. The brain has a surprise center. The neuroscientists call it as an OOP center called the ACC, anterior cingulate cortex. When surprise springs on ACC, it activates the hypothalamus, and that is why even if there is a short fall of a small magnitude in EPS, the market can sometimes crash. Finding 19. I understand that a lot of your members are females, and this finding may be very reassuring to them in some ways. Advanced neuroscience suggests that there are significant differences between the male and female brain. While female brains forge a strong connection between the right and left hemispheres, male brains have a better connection between the front and the back lobes. Men have a larger inferior parietal lobe, whereas women have a more complex limbic system. It has the following implications. Women tend to use both sides of the brain, whereas men primarily use only the left side when making decisions or performing tasks. Compared to men, women can draw connections between words and emotions more easily and intuitively. Further, women are more sensitive to sound and language that enables them to express their emotions verbally more easily. Finding 20 human rationality typically depends on sophisticated emotionality. By this time, it is very clear that reason and emotion must work together to create intelligent behavior. And Daniel Kahneman has coined the term emotional intelligence, an eminent psychologist, PhD from Harvard. He has been saying that emotional intelligence matters more than IQ. These are the components of emotional intelligence. It is concerned with the ability to identify one's emotions as well as those of others, and the components are self-awareness, self-regulation, motivation, empathy, social skills. The prefrontal cortex and the strength of its relationship between with the limbic system determines a person's emotional intelligence. I often say Vishnu is probably the epitome of emotional intelligence. A person with emotional intelligence is able to remain calm, composed, unruffled, irrespective of how turbulent the environment may be. Look at this picture. Vishnu is lying in a reclining posture on a snake which is on a sea, and the sea is the most turbulent thing that you can imagine. It is like the stock market with a lot of turbulence, but Vishnu seems to be calm, steady, serene, composed. He is not at all ruffled or bothered by the turbulence around. And who is serving Vishnu? It is Lakshmi, goddess of wealth. In many places, I find that people tie an idol of Lakshmi to the ground or to the wall because they say Lakshmi is very fickle. Lakshmi बहुत चंचल होती है, and we have to tie the goddess of Lakshmi, otherwise it will go away very easily. But look at Lakshmi here. She is serving Vishnu very, very faithfully, steadfastly. She is showing no signs of fickleness because Vishnu embodies emotional intelligence. He is calm, composed under the most trying and turbulent of circumstances. Whereas we are born with a certain level of IQ or native intelligence that does not change much over the teenage years. Emotional intelligence is largely learned. Over time, we can improve our ability to manage our impulses and emotions and motivate ourselves and become more socially available. The old-fashioned terms are character, maturity, and temperament. The Brave New World, a peep into the future. I started by saying quantitative finance, behavioral finance, and neuro finance are the three strands of finance. You will have to tell me 5 minutes in advance as to when I should stop and take the question because I think I'm running short of time. Saurabh?
Yes, sir. So maybe another 5 minutes, and then maybe we'll have around 15 minutes of Q&A.
Okay, then I'll probably skip some certain things. I'll share the presentation for those who want to go through it. There are three stages in the intellectual ideas, in the diffusion of in the success of intellectual ideas, like the diffusion of new products in the marketplace. The framework of intellectual ideas is built but is known and understood by a small group of academics or leading industry users. Early adopters implement the ideas. Most successful ideas become widespread and institutions are built around these ideas. Quantitative finance is in stage 3. Successful institutions have been built, whether you look at Vanguard, which has pioneered the index fund, or a lot of successful hedge fund managers like Simmons and others. They have built institutions around quantitative tools and techniques or ideas which stem in the field of quantitative finance. So quantitative finance has reached a point where institutional structure is being built. Behavioral finance is in the second stage, neurofinance still in the first stage, with some signs of moving in the second stage. And it is a long, long way to go. Even behavioral finance will have tremendous challenges to move to stage 3, and some say it is not possible because it doesn't have a coherent theory. Anyway, all I am trying to say here is that we have 3 strands of finance. Quantitative finance is highly developed. Behavioral finance has reached a certain stage of maturity. Neurofinance is still in the first stage. Of course, Ming HSU, a pioneer, where he says, just as Bogle's index fund democratized the world of finance in an unprecedented uh, wave, dynamic indexes will now take over. The most sophisticated versions of dynamic indexing strategy will take into account your particular financial objectives and constraints, your current and likely future circumstances, and all sorts of personal attributes. Uh, uh, he gives a very interesting example. He says, imagine that you're wearing an Apple Watch which monitors your physiological state and is connected to a portfolio management app called Warren. Using financial and physiological data from millions of other investors provided by participating brokerage firms and their clients, Warren can determine whether you're freaking out in response to a market decline and will help you to manage your risk and emotional state. So this is the kind of world that will emerge in the years to come. Uh, uh, it's a very ambitious project, but many say just the way 20th century was the century of electrons, 21st century would be the century of neurons. Till we have those technologies in place, we have to rely on making positive changes in our investing and life. And these are the traditional ways of doing that, which I strongly recommend to everyone. Attitude of gratitude, pranayam, yoga, meditation, exercise, journalizing, cognitive behavioral therapy, positive attitude. These are ways and means by which you improve your emotional intelligence and become a better investor and lead a better life. Flame University near Pune has been founded by people who are wedded to Vipassana in a way, and they are all eminent investors. Uh, uh, and they have been saying that Indian wisdom lies in Vipassana. You achieve a higher degree of equanimity, which leads to success in markets and life. Likewise, your Chinese wisdom propounded by Lao Tzu, he who knows much about others may be learned, but he understands himself more intelligent. In the Western tradition, Hippocrates said, men ought to know that will enjoy nothing but the brain comes. With the brain comes joy, delights, laughter, sports, sorrow, grief, respond. If I have to offer 5 guidelines, they are as simple as this. I'm sure all of you are familiar with them, but I have found them very useful in disciplining investment decisioning. Focus on the big picture, the asset allocation, rely on words and numbers, not sights and sounds. Words and numbers activate the reflective brain, sights and sounds activate the reflexive brain. Our objective is to ensure that reflexive brain doesn't dominate reflective brain. Diversify moderately, control the uncontrollable and do not forecast stock prices. Periodically review and rebalance. I'm almost done. I'll probably go to the last slide. Okay, I'm done. I am willing to now take questions that some of you may have.